The European Central Bank just made its first interest rate cut since 2019. And honestly, it's a big deal. It affects how much you pay for your mortgage, how your savings grow, and even how stable your job is. But this decision isn't just about numbers. It actually reveals something deeper about where Europe and the global economy might be headed. On June 6th, the European Central Bank cut its main interest rate, the deposit facility, by 25 basis points. That brings it down from 2.25% to 2%. Why does this matter? Because this rate influences how expensive it is for banks to borrow money, and, by extension, how expensive it is for consumers and businesses to do the same. The ECB's logic? Inflation is falling. In May, Eurozone inflation was down to 2.6%, much closer to the target of 2%. At the same time, economic growth is stalling. Germany barely avoided recession. Italy's growth is flat, and French households are spending less. The ECB is hoping this rate cut gives the economy a push, without reigniting inflation. So what does this mean for you? If you have a variable rate mortgage, your monthly payments may drop slightly. It won't be dramatic overnight, but it could help ease the pressure. Personal loans and credit cards may become a little cheaper, especially for new borrowers. Small businesses might also find it easier to access financing. If you're someone who relies on savings interest, this isn't great news. Expect to earn less on your deposits. The euro is likely to weaken. That could make European exports more competitive. But imports, especially fuel or foreign food products, could become more expensive. So why did the ECB move first? Why not wait for the US Federal Reserve or the Bank of England? Well, Europe's recovery is different. While the US economy remains hot, Europe is cooling, and honestly, arguably stagnating. Consumer demand is weak, manufacturing output is down, and though wages have risen, they're not really driving inflation anymore. ECB President Christine Lagarde put it this way: "We are not declaring victory over inflation, but we see enough evidence to ease slightly." That kind of caution is key. They're cutting, but slowly. Markets had already priced in this rate cut. But what really matters now is what comes next. Will the ECB cut again in July, September, or maybe pause to wait for new data? Investors are pretty divided. Some think this is the beginning of a steady easing cycle, while others say the ECB may pause, especially if inflation ticks up again. Meanwhile, the euro fell slightly against the US dollar. European stocks reacted positively. Banks, in particular, welcomed the move. The ECB is now the first major central bank to begin cutting in 2025. But the US Federal Reserve, not yet. Inflation in the US is still sticky, and the Bank of England is also cautious. If other central banks wait and the ECB cuts further, the euro could continue to slide, which, has its pros and cons. Emerging markets that trade in euros could benefit from a weaker European currency, but global investors may shift capital away from the EU toward higher-yielding economies. The ECB is walking a tightrope, trying to support growth without reigniting inflation. And honestly, the world is watching. What do you think? Is this a smart move? Or is Europe moving too fast, too soon? Let us know in the comments. And if you want more clear global insight on the biggest events shaping our world, subscribe to the International Lens. See you in the next video.